You're staring at your credit card statement again, the one that came in a plain white envelope with that little transparent window, like it's trying to hide what's inside. You tell yourself you'll look at it later. You put it under a stack of mail, maybe under that takeout menu from 3 weeks ago, and then you forget about it until the next one arrives, and now there are 2 unopened envelopes staring back at you from the kitchen counter. You know the number inside is bad. You don't know exactly how bad because you stopped checking a while ago, but you know it's bad enough that you feel a little sick every time you open your banking app. You make the minimum payment every month, sometimes a little more if you had a good week. But the balance doesn't move. It sits there like a fat toad on your financial chest, breathing slowly, taking up space, reminding you that you made decisions you're not proud of. And the worst part? You're smart. You work hard. You're not out there buying designer handbags or financing luxury SUVs. You just lived. Groceries here, a flight to see family there, new tires for the car, and a couple of nights out because you needed to feel normal. And somehow, without any single disaster, you ended up with 5 figures of debt that feels impossible to escape. My name is Vicky, and I spend way too much time thinking about why smart people stay broke. Not because they're lazy or stupid, but because the financial system is designed to exploit how your brain naturally works. If you're someone who has looked at your credit card balance and felt that unique blend of shame, confusion, and quiet panic, hit subscribe and give this video a thumbs up. Because today I'm going to show you exactly how I eliminated my credit card debt in 12 months using balance transfers, not by earning more, not by winning the lottery, not by living like a monk and eating rice and beans for a year. I'm going to show you the math, the psychology, and the step-by-step strategy that made it work. And I'm going to tell you the one mistake almost everyone makes with balance transfers that turns them into a debt trap instead of an escape hatch. Here's the thing about credit card debt. It's not the amount that destroys you, it's the interest rate. Most people look at a $10,000 balance and think, okay, I need to pay back $10,000. That's not wrong, but it's incomplete. What you actually need to pay back is $10,000 plus whatever interest accrues while you're paying it down. And on a typical credit card with a 22% APR, that interest is absolutely brutal. Let me do the math for you in plain terms. On a $10,000 balance at 22% interest, if you only make the minimum payment, usually around 2% to 3% of the balance, you will spend over 14 years paying off that debt. 14 years, and you will pay nearly $9,000 in interest on top of the original 10 grand. So that $10,000 of stuff you bought, groceries, gas, a plane ticket, some takeout, it actually costs you $19,000. That's the hidden tax on financial illiteracy. That's the price of not understanding how compound interest works when it's working against you instead of for you. Now look, I'm not here to shame anyone. I carried this debt myself. I made the same mistakes. But once I understood the math, I realized something critical. The problem wasn't that I owed $12,000. The problem was that every month, $220 of my payment was evaporating into interest before a single dollar touched the principal. That means when I made a $400 payment, only $180 actually reduced my debt. The rest was just rent I paid to the bank for the privilege of being in debt. So I asked myself a question. What if I could make 100% of my payment go to the principal? What if I could pay 0 interest for a while? That's when I discovered the weapon that changed everything, the balance transfer. But here's where most people get it wrong. They hear balance transfer, and they think it's just moving debt from one card to another. They do it once, feel good for about 30 seconds, and then they're right back where they started because they didn't change their behavior. Or worse, they use a balance transfer, keep spending on their old card, and end up with 2 balances instead of 1. That's not a strategy. That's rearranging deck chairs on the Titanic. So let me be crystal clear about what a balance transfer actually is and how you use it as a weapon, not a crutch. A balance transfer is when you open a new credit card that offers a 0% introductory APR on transferred balances for a set period, typically 12 to 21 months. You move your existing high-interest debt onto that new card, and for that promotional period, you pay 0 interest. Every single dollar you send them goes straight to the principal. That means if you owe $12,000 and you can pay $1,000 per month, you're done in a year. No interest, no $9,000 penalty, just clean linear progress. That's the math. But here's the psychology that nobody talks about. When you make minimum payments on a high-interest card, your brain feels like you're doing something. You're paying the bill. You're being responsible. But because the balance barely moves, you get 0 dopamine from the process. There's no reward loop, no sense of progress, so you stop trying as hard. You maybe throw an extra $50 at it here and there, but it feels like trying to empty the ocean with a spoon. A balance transfer changes the game because now every payment creates visible, measurable progress. When you send $1,000, your balance drops by $1,000. You can watch the number fall in real time. That creates a psychological feedback loop that actually motivates you to pay more, not less. This is why I say balance transfers aren't just a financial tool, they're a behavioral hack. Now you might be thinking, Vicky, this sounds great, but don't balance transfers have fees? And won't opening a new card hurt my credit score? Let me answer both objections directly because they're valid questions, but they're also the excuses people hide behind to avoid taking action. Yes, most balance transfers charge a fee, typically 3% to 5% of the amount you transfer. On a $10,000 transfer, that's $300 to $500. Is that a lot of money? Absolutely. But compare $500 to the $9,000 in interest you would have paid over 14 years. That's not a fee. That's a discount. That's paying $500 to save $9,000. Anyone who tells you that's a bad deal either failed basic arithmetic or has never actually carried high-interest debt. As for your credit score, yes, opening a new card will cause a temporary dip, usually 5 to 10 points, because of the hard inquiry and the reduction in your average account age. But here's what most people don't realize. Paying down a large balance rapidly will improve your credit score far more than that small, temporary dip. Your credit utilization ratio, the percentage of available credit you're actually using, is one of the biggest factors in your score. If you transfer a $10,000 balance to a new card with a $12,000 limit, your utilization is still high. But as you pay it down, that utilization drops fast. I've seen people boost their scores by 50 to 100 points within 6 months of executing a proper balance transfer strategy. This is where it gets interesting. The real secret isn't the transfer itself. It's the plan you build around it. Most people fail at debt elimination not because they lack willpower, but because they lack structure. They decide to get serious about debt, but they don't actually change how their money moves. So let me give you the exact protocol I used. Step 1. I stopped using credit cards entirely. Cold turkey. I didn't cut them up because that felt dramatic and unnecessary, but I locked them in a drawer and removed them from every digital wallet, every saved payment method, and every autofill form. If I couldn't touch the physical card, I couldn't use it. For 12 months, I lived on debit and cash. That's non-negotiable. You cannot dig a hole and fill it at the same time. Step 2. I calculated exactly how much I could realistically pay each month. Not optimistically. Not what I wished I could pay. Realistically. I looked at my income and my essential expenses, rent, utilities, groceries, transportation, and insurance. And I found the number. For me, it was $950 per month. That wasn't fun. It meant no restaurants, no new clothes, no travel, no impulse buys on Amazon at 11 p.m. But here's the thing. I wasn't doing those things anyway because I was broke from debt payments. At least this way the money was actually working. Step 3. I found the right balance transfer card. And this matters more than you think. Not all 0% APR offers are created equal. I looked for 3 things. The longest promotional period possible, ideally 18 to 21 months. The lowest transfer fee, 3% is good, 5% is okay if the term is long, and a decent credit limit that could cover my full balance plus the fee. I applied for 2 cards to be safe. Got approved for one with an 18-month 0% APR and a 3% transfer fee. Transferred the full $11,400 I owed at the time. The balance plus the fee rolled in, and suddenly my $950 monthly payment was taking a real bite out of the principal. Step 4. I automated everything. I set up auto pay for the exact amount I calculated, $950 every month on the same day I got paid. Not the minimum, not a variable amount, the fixed, non-negotiable amount. This is the psychological trick that separates people who succeed from people who struggle. When you automate, you remove decision fatigue. You don't wake up every month and ask yourself, should I pay extra this month or buy those sneakers? The money is already gone. You can't spend what you don't see. And here's what happened. Month 1, balance dropped from $11,400 to $10,450. Month 2, down to $9,500. Month 3, $8,550. Every month I watched that number fall by exactly $950. No interest, no surprises, just clean, predictable progress. By month 9, I was under $3,000, and that's when something unexpected happened. I started getting excited about paying. It became a game. I found an extra $50 here and there, returned a deposit, sold some old electronics, and skipped a few coffees, and threw it at the balance. By month 11, I was done. 12 months exactly from $11,400 to zero. No windfall, no second job, no inheritance, just a balance transfer, a realistic budget, and automated payments. But I'm going to be honest with you. That's not the whole story. Because what I haven't told you yet is that I tried balance transfers before and failed twice. And those failures taught me more than success ever could. The first time, I transferred a balance to a 0% card, felt incredibly smart for about 2 weeks, and then kept using my old card because I told myself I needed it for emergencies. Within 4 months, my old card had a new $3,000 balance, and my new card still had $9,000 on it. I was worse off than when I started. The second time, I transferred the balance, but only paid the minimum because I convinced myself I'd pay more next month. Next month never came. The promotional period ended, and the interest kicked in at a punishing deferred rate. Some cards will charge you all the back interest if you don't pay the full balance before the promo ends. And I owed even more than before. That second failure nearly broke me financially and psychologically. I felt like an idiot. I had the tool. I had the knowledge. And I still screwed it up because I didn't have the discipline. And that's the part that no YouTube video, no personal finance book, no TikTok hack can give you. You can have the perfect strategy and still fail if you don't fix the behavior that created the debt in the first place. So let me say this clearly. A balance transfer is not a solution. It's a tool. And like any tool, it can build a house or blow your hand off depending on how you use it. The solution is changing your relationship with credit. It's understanding that credit cards are not free money. They are not an emergency fund. They are not a way to smooth over cash flow problems. A credit card is a short-term lending instrument with brutal terms for borrowers who don't pay in full every month. That's it. Once I accepted that, really accepted it, not just intellectually, but deep in my gut, I stopped treating my credit limit like a target and started treating it like what it actually is, a liability with a smiley face. Here's a statistic that should scare you. According to data from the Federal Reserve, the average credit card interest rate as of last year was over 22% for accounts that carry a balance. 22%. The average stock market return over the last 50 years is about 10% per year. Do you understand what that means? Carrying credit card debt is mathematically twice as powerful as investing in the stock market, but in the wrong direction. Every dollar you put toward debt gives you a guaranteed 22% return on your money, because you're avoiding that interest. Name one investment that guarantees 22% with zero risk. You can't, because it doesn't exist. Paying off high-interest debt is the single best investment you can make, period. Now, you might be sitting there thinking, okay, Vicky, I'm convinced, but my credit score is terrible. I can't qualify for a balance transfer card. I hear you, and that's a real obstacle. But here's what most people don't realize. You don't need a perfect score to get a balance transfer card. Many issuers approve scores in the 600 to 660 range. And if you're below that, your first step isn't a balance transfer. Your first step is a secured credit card or a credit builder loan to raise your score for 6 to 12 months. Or you look at credit unions. They often offer lower rate balance transfer options, even for members with challenged credit. Or you call your existing card issuer and ask for a hardship program. Banks will sometimes lower your interest rate to 5% or 6% if you tell them you're struggling, because they'd rather get something than send you to collections. The option exists. You just have to ask. And if none of those work, then you go aggressive on the debt snowball or debt avalanche methods. Balance transfers are the optimal strategy, but they're not the only strategy. The real enemy isn't the lack of a 0% offer. The real enemy is inaction. It's telling you you'll start next month. It's opening the statement, feeling that wave of shame, and closing the app without doing anything. That's what keeps people in debt for years. Not high interest rates, not bad luck, avoidance.